Good afternoon, everybody. Thank you for joining us. And I hope to follow the advice of one of my great mentors, which was to be brief, be bright, and be gone. In this case, the be gone is to allow you guys to ask questions. So I will move fairly briskly through here, but I'm doing so in the hopes that we might have some good questions to dig into areas that are of more interest to you as the listeners. So as a little bit of background, I've got to do my advertisement for the firm and for myself. So the firm itself is a 30-year-old boutique investment firm based in New England, here in the Boston area. We are one of the largest of those firms in New England. We've closed multiple transactions. It's 12 in the last 9 months, so we're quite busy. We have expertise in a number of verticals, including information technology, software, consumer, but one of the main areas of focus for us is healthcare and healthcare technology. We tend to deal with companies that are in what we look at as being the middle market or lower middle market. That is transactions under $400 million, which is pertinent to the discussion that we'll be having today and the data that we'll be looking at. But we tend to work very much with closely held high-tech companies that get sold to large multinational, multi-billion-dollar acquirers. We take great pride in the fact that we work closely with our with our clients, that we really get engaged in what they're doing, a great deal of commitment to everyone as an individual, the shareholders, maximize returns. Tom's pretty much hit on myself, but as he said, I spent quite a while with Stryker doing marketing, M&A, and joint venture work. Then left, started my own companies, bought my own companies, sold them, and have been a board member that's bought and sold companies. So I like to think that I have a unique view of the M&A process, on top of being an active advisor in helping companies through to their exits. I do tend to focus in the device arena. And think of the middle of the bullseye being the operating room, and then radiate out from there. As you can see, that a lot of companies that you might think of as being serial acquirers, are the companies who we indeed work with on a regular basis. So let's dive into the market itself, and what I'm going to attempt to do here is start fairly high, 30,000 feet, and then drill down and get more and more granular. So let me start up at the 30,000 foot level, and as most of you likely know, there is a strong economy still, even with some of the gyrations that are going on. There is abundant capital, really abundant capital, whether that be in private equity, whether that be on companies' balance sheets. Companies are strong, have a lot of cash, and are looking to put it to work. If there's any question, it's how long is that going to last? And things have settled down after the election, and certainly seem to be suggesting that they're settling in an even more positive trend, and hopefully that will continue. Before the election, we were most likely to say we think it will continue, but we're probably closer to the end of the cycle than the beginning. But we're rethinking that now based on how we're seeing the economy in general and companies in specific react to the election. But in general, the M&A market continues to be very strong. The middle market in particular, valuations strong, number of deals strong. If we start to dive down into the medical device sector and look at what's going on with the public companies out there, they're definitely outperforming the broader public indices, which is not surprising when you look at some of the dynamics around these companies: aging population, living longer, expecting a higher quality of life. It's in general a very good place to be, and a lot of dollars being spent there. If you look at the EV revenue, EV EBITDA multiples, they are growing and growing rapidly. 3.8 most recently is the average. But if you look at the most acquisitive companies in the med device sector, which is what we're going to be looking at, many of them are trading at 4.2, 4.4, 4.8 times revenue, and that also plays into why you're seeing some of the transaction multiples that you are. So again, staying up at a fairly high level, if we look at our data set that we work with in the broadest sense, and that's healthcare equipment and supplies. So that's a fairly broad bucket, and that includes medical devices. You can see the number of deals is holding very steady, and that even valuations are as steady to maybe even trending up. As most of us know, 2014 had a number of really large blockbuster deals, the Covidien deal being the largest one, which skews that data a bit. But we're continuing to see strong mega and also large deals, multi-billion-dollar deals, and they are large strategics buying other medium to large strategics and spending good money to do so. So now what I want to do is with that as background is drill down a bit more into what we call the lower middle market for devices and what's going on there, because in a way that's where most of us are going to have our exposure to the M&A experience. Most of us are not going to be involved in a multi-billion-dollar deal, but if you look at the numbers, we have a much higher probability of being involved in something that fits within this lower middle market spectrum. So why do we focus on it? Why have we done this? The research that we've done. This is where the majority of the deals are done. When we looked at all the medical device deals done over the last 5 years, and that's from the middle of 2011 to the middle of 2016, we identified 250 deals where there was publicly available information. So again, the data set is really those where public information is available. We can verify that the deals were done. So of those, 75% have published transaction values of under $400 million. The reason that the ones over $400 million get all the attention, though, is that they make up by far the largest amount. So 25% of the deals make up a large part, 5 times the value, 113 billion in the large deals versus 22 billion for the smaller deals. We did this research also because this is the area in which we as a firm focus on. And when we did research for our clients, there was a real dearth of publicly available information on transactions in this space. And so I will give a shout out to our 2 summer interns from this summer who helped me with the work. But it really did take a tremendous amount of legwork to come to this data set, which it became clear that that's why there probably wasn't a lot of information out there. So from a methodology standpoint, we started by using S&P Capital, S&P's IQ Capital, or Capital IQ, I should say. And then it was really a lot of legwork on our part to vet every deal, make sure the numbers were right, make sure that it fit within the spectrum in which it was categorized, to come up with the data set that we have. Again, middle of June to the end of June 2016. And again, we removed deals that we found that were under 400 million and focused on devices only, and removed diagnostics suppliers and subcontractors. What we ended up with was a data set that had 186 companies where there was reliable data that reported on enterprise value or transaction value. 71 of them had enough data to analyze enterprise value to revenue multiples. And interestingly, as you'll see, there were 30 additional deals that were pre or early revenue where there may not have been any revenue to be reported. So of the 71 that we could look at EV to revenue multiples, there were two subgroups, cardiovascular and orthopedic, where we felt there were enough data points where we might draw at least some conclusion based on the trends that we were seeing with those subsets. So taking a step a little bit back, what's going on out there from a more general mindset standpoint? And again, 2014, even into 2015, and even this year, continuing to see larger acquisitions as companies are looking to gain girth, gain size, gain negotiating capabilities, and they're also looking to own disease areas, continuums of care, so they're placing bets in an attempt strategically to own those areas and have the ability to negotiate the best possible deals for themselves. As part of that, there's definitely a committed strategy, and you can see some quotes from some of the largest acquirers here, Stryker, Medtronic, and Teleflex, are the most active acquirers, I should say, that they really have a commitment to backstop these large acquisitions with what they call tuck-ins, which fit in the lower middle market space. And that is that they've established a strong foothold in a specific area or built out an adjacency, and now they want to fill in and leverage that investment that likely includes distribution channels, manufacturing, expertise in the area. They can further leverage that larger investment by buying smaller tuck-ins that allow them to leverage the investment that they made. So, below are some of the more recent deals. Just to have a few out there, you see a range of transaction multiples. I realize that you'll see I've got the Sequent Terumo deal on there twice. It must have been subconscious, but 38 times revenue is certainly something that gets one's attention. And interesting also that Terumo is a company that 5 or 10 years ago one might have thought of being outside of the medical device arena, that's really making a commitment financially and strategically to build into the space. Certainly with the likes of Medtronic, Stryker, these are the traditional powerhouses that are looking to increase their footprint in the space. So getting into the data a bit here, which is what everybody's most interested in. Again, when we look at the lower middle market device deals, the number of deals is holding very steady over the last 5 years, and the valuation has held very steady. It's an interesting anomaly. I don't think there's anything in it. That the lowest year from a valuation standpoint in the lower middle market space was 2014, and that was the year that all the mega deals got done, or the notable mega deals got done. But again, I think the real takeaway here is that the average valuation is holding quite steady, and as you'll see in some areas, it's even trending up. And when you look at how the first half of 2016 is shaping up, it certainly seems to be on par with 2015 based on what we're hearing on the street, we anticipate that it may come in. It may come in competitive with 2015, perhaps a bit below, but certainly within the spectrum of the what we've seen over the last 4 or 5 years. And again, valuations continuing to hold quite strong. This next image is an attempt to give a synopsis shot of a heat map of sorts of who the players are, because as they have consolidated, there have been fewer and fewer players that are again they're looking to increase their footprint, and I think this really demonstrates that well. And just a note on this image, the size of the rectangles is commensurate with the number of deals done. The shading gives some indication of the total value of the deals done. The shading is a little misleading, and I just want to make sure I point it out, because there are several companies, Zoll, Zimmer, come to mind, where they don't provide information on a lot of information on deal value. So they may be we want to indicate that they are active acquirers, but we don't know what they're doing necessarily from a total value standpoint. But the real takeaway here is that you've got the big guys who are definitely working to get bigger. Looking again, this is over 5 years. So Covidien, Medtronic, Covidien, if you combine them, are doing several deals, oftentimes a year. Certainly, Stryker has been active and getting more active. They've spent, if you look outside the lower middle market, spent well over $3 billion in the first quarter of this year, and have added several tuck-ins since then. So definitely, the big guys looking to add on and get bigger. If we go to try to get a sense of the subsets that we talked about, orthopedics, cardiovascular, and other, and in that other area, you've got your ophthalmic companies, women's health, companies such as that. What you see is that if we trend this, that in general the trend is steady to slightly up. In cardiovascular, it's definitely trending up. Orthopedics suggests that it's trending slightly down. Again, I take general and orthopedics and look at them and feel like it's more flat than trending in a direction. But really, cardiovascular is definitely probably the hottest space in the med device arena right now, and the data tends to play that out. I do want to note, as it says on the right-hand side, that the trend lines include 3 deals that we couldn't fit on from a scaling standpoint for the bubbles, but on the right you see 3 of the most impressive deals from a revenue multiple standpoint, and again, not shockingly, they are in that cardiovascular, neurovascular space. Again, one of the other really interesting dynamics that we're seeing out there, and may be of interest, particular interest to the folks on this call, is that there are pre-early revenue deals that are getting done, and we lump those together. Again, we've got Sequent in here. They were doing publicly, the numbers suggest they were doing someplace around $10 million a year outside the United States when they were acquired, but we're in the process of getting their regulatory approval, or just gotten their regulatory approval, and so really this is meant to capture those where they're at the point where they're really just entering, particularly the U.S. market, and there really has been an uptick in the number of deals that are being done that fit this set, and the valuations are truly impressive. The leader of the lot is Boston Scientific, having done 6 pre-early revenue deals. in the last 5 years. There's one outlier in that group, but if you take out the outlier, for their deals alone, a median of valuation of $230 million. But certainly you can see there are other companies other than Boston Scientific that are working in this space. Again, if you look at the spread, a lot of it's in the cardiovascular, neurovascular space. But the ophthalmics companies are certainly making more of these, what are being called, at least the term I'm hearing, is upstream investments. And in our discussions with the corp dev senior level people at these companies about this dynamic, the general feeling is that two things. One, they recognize that venture investment in these in med devices has gotten much more difficult, particularly when you look to raise the $10 to $20 million range. And so there's a risk that better technologies may not be coming to market. So they want to make sure they're taking a look at some of these earlier stage companies and make sure they don't get lost in the inability to get funded. But two, in looking at their results from their investments, they're making a play that you can, for the price of a later stage, more developed, fully baked revenue generating company, for what you'll spend on that, you might be able to do 3 or 4 deals on these more upstream companies. And on top of that, you'll then be able to apply your capabilities from a regulatory, manufacturing, channel standpoint to have more control over ensuring the success of the companies. So it's been an interesting strategic shift that we've seen, and certainly there are a large number of deals that are being done. But as I say here, and I'll say again, you need to be in the right place at the right time. You really need to be plugged in. You need to be listening to what the companies that are the acquirers, what they're talking about, the future, being the future for the company, the areas that they are looking to grow into. You need to be wise about where you are spending your time and effort developing these earlier stage companies, if your goal is perhaps to have an earlier stage exit. So let's boil it down. Highly acquisitive space. It doesn't look like it's slowing down. We don't anticipate it slowing down anytime soon. Valuations are strong. They're a multiple of revenue. As we've said, the large companies are looking in the lower middle market for tuck-ins to build out the footprint to maximize some of these larger investments they've made. 2016 trending quite well. As I've said, I think the future is going to continue to be strong, barring some macro event. And having been an entrepreneur myself, I try to always finish by saying that it is worth the pain, suffering, and for those of you who've done it, the groveling that it takes to build a company and to be an entrepreneur. But again, to remind you to be smart about where you're picking to go, where you're targeting your efforts, and how you go about positioning your company, your technology. But in the most general terms, again, you're looking at 3x, 4x, 5x returns or revenue multiples for these companies in this space. And even in the pre-early revenue companies, again, right place, right time can garner very, very nice returns. I'm going to end there, but I also want to touch, I should have done it at the beginning, and let you know that on the teaser for this, there was, I think on the agenda was that we were going to touch on M&A best practices, and looking at that as we started to build that out, that's a whole lengthy presentation in its own right. And so I've talked with Tom and look at maybe coming back in the next year or so and doing another presentation on M&A best practices to help you from that standpoint. And then further, as Tom mentioned, we do have a white paper that we're publishing that digs into even more detail on this data that I've presented here. And we'll be sending out an email to all who have registered for the presentation, and we'll be sending out a link to be able to gain access to that white paper, hopefully sometime beginning of next week. And with that, look forward to taking hopefully some questions.
Great, thank you, Patrick. I'd like to encourage you now, if you haven't done so already, to pose some questions to him. We have a few minutes to let you do that. I notice there aren't any questions that have been posed thus far, but let me give you a few minutes to see if you would put some thoughts or questions into the box, and we'll be happy to read it. We will not attribute them to you. They'll be asked quite blindly. So with that, let's get. We've got one already, so let's get to that question. What are the what are the top traits of just a second, of pre-revenue companies you believe are important to trigger acquisition? So the question again is, what are the top traits of pre-revenue companies you believe would be important enough to trigger acquisition interest?
It's a great question, one we get on a fairly regular basis, because you go through the, do I go out and try to raise money to do to try to get this to the next round, dilute myself further, or do I look, can I look to do an early exit? So for the most part, you need to, it's all about risk, right, and risk mitigation, and so it's, the traits that we see to answer the question bluntly is you really need to have human experience. There needs to be a collection of inhuman, first-in-man experience. It doesn't necessarily have to be in the United States, but in most of these cases, there's some human experience. Number two, you need to have a very strong patent portfolio that can bear the vetting process. And in fact, that's what the investment is in the technology, in the IP, so that needs to be solid. You need to have solid preclinical work in place, and in most cases, you need to have your FDA approval in hand or certainly pending. I think there are a few where they've had successful panel meetings, the final announcement hasn't come out yet, but in most cases, you need your U.S. approval as well. So again, first-in-man experience, solid preclinical, solid IP, and at least approval in hand or certainly well on its way in the United States.
Okay. See if there are any other questions that have come through. No, not at this point. Oh, wait a minute, here we go. We've got a couple coming in now. Any insights on medical software companies, medical device software companies, and or medical imaging buyers, for example, buyers such as Siemens, Philips, GE Medical? What are the top, excuse me, I'm sorry about this. Our software here is not helping us read this question. Let me go back to the first question here. So let's see. Any insights on medical device software companies and or medical imaging? Examples, buyers such as Siemens, Philips, or GE Medical. Any insights? Those companies.
Yeah, that starts to be a little bit more outside of my area of expertise, but I tend to see them as being a bit more conservative, and the number of smaller tuck-ins don't seem to be as large. Again, we didn't look at them in this data set, so I don't have numbers off the top of my head, or even a gut feel based on the numbers, looking at the data set. But from what I'm hearing on the street, that the general sense is more conservative and less tuck-ins on the imaging side of things. I'm sorry I don't have a lot more detail I can give you on that.
Okay. Another question has come in. Just a second. Okay, EV as well.
EV multiples for...
Any insight into EV multiples for service industries, that is CROs?
Yeah, again, that's a good question, and that one I've got, I think, a bit more familiarity with, because a couple of my colleagues are more specialized in that set, and have worked on some deals with them in that space. It tends to be a broader range, and it depends on what the company is offering. Is it a truly just a services company, or is there some unique value add to the company? But I'll try to answer your question by giving you a bit of a range. On the more service provider side of things, with no unique product or service, you tend to start to trend there more into valuation based on EBITDA, and you're looking at 6, 7 at the low end to up to 10, 11 times EBITDA on the on really well run profitable companies. But as you get into proprietary companies that may have unique product offering, unique value add, you're looking at anywhere between 1 and 2.5 times revenue. And again, it's a wide range, because that's a fairly wide spectrum of it's a pretty big bucket with a lot of variability in it.
All right, let's see if there's anything else that has come in here. Again, if you have a question, feel free to pose it. Looks like that's the first one was the top traits.
Okay.
Yeah, revenue, EV. Are you hearing any comments? Sorry about this, folks. We're having software, medical device company. Okay, that looks like it's it. Again, if there are any other, if you have any other questions, please feel free to pose them now. We're just going through the questions that have been posed thus far in a very limited window. Here's another one. Okay, go ahead.
The software is very interesting. We've got one thin sliver to read the questions in. It says, any insight into EV multiples? Oh, no, sorry.
Oh, that's the one.
Any comments on acquirers on how potential changes to the ACA, et cetera, are affecting their view of acquisitions?
Right.
Yeah, really, really good question. And one that kept me up, and I think it's still keeping me up, wondering about, and I almost said worrying about. Before the election, I was going to say worrying, and now I'm wondering. And this is purely my gut feel, my personal opinion, but I think you're going to see companies not do anything irrational here. That the macro issue remains, which is the cost of healthcare is too high. Not enough people have coverage who should. These are problems that are going to need to be solved. They'll be looked at in a couple of different ways, if not many different ways. But in the end, the use of the data that we've got and outcomes measurements to drive to drive improvement in those areas is going to be an overarching dynamic that we as an industry continue to have to have as the most important thing we look at. And so from that standpoint, how is it driving their view of acquisitions? One, I think that it is the sense is that they can be maybe a little bit more free in the near term. They're not going to get clamped down by a more an even sort of harsher version of the ACA, and with everybody really pressuring price. So I think companies may be a little bit freer, but the focus, which it has been, will continue to be on what are the companies, what are the technologies that are going to improve outcomes in the broadest sense. What's going to get people, keep people out of the hospital, what's going to get them out of the hospital sooner, and what's going to keep them from getting sick. Those are the technologies that companies are focused on and will continue to acquire.
Yeah, I'm interested, Patrick, in that same vein, the whole notion of patient engagement, a program that we're putting on later next month, I guess, technically, January 31st. That's a concept that was really pushed in the ACA, getting patients involved, the whole area of digital health, and not only standalone apps, but also features of medical devices that allow patients to monitor their own health. Same situation. You think a trend like that would continue and would be of interest to large OEMs as they look across the spectrum of startups?
Yeah, in a word, yeah. For the same dynamic. I mean, it's all about engagement, outcomes, and improving that. Whether it be for purely capitalistic purposes, insurance companies wanting to drive reduction in the cost, to appropriate ethical purposes, which is trying. Most people are in this business, myself included, because you like to feel like you're making a difference in people's lives, and so we as an industry, I think, are driven by that as an underlying motivation.
Okay, I think there's another question that's come in here now, and I think we're able to look at these a little bit better now. How often do you see VC partnering with acquirers, and what do those relationships look like? So venture capitalists partnering with the strategics.
We're seeing that in the earlier stage of development side of things, and I think that's where the question is going here. We are seeing deals where, say, J&J Development Corporation, or similar body from any one of the number of larger companies may go in on a development round with venture companies. So and I think that's been an interesting development, to tell you the truth. And I've actually seen rounds raised where you have more than one strategic in with more than one venture group. And I imagine that makes for interesting board meetings. But for the most part, I think everybody has their hats tilted in the right direction in those investments, and that for the most part there aren't tremendously onerous, unless both sides want it. Right of first refusal probably being the most onerous, but no requirements to sell to. It's really an investment in the technology, a chance for these bigger companies to learn perhaps a new area that they're looking at, and have a foothold if the technology or company is ultimately successful. So it is something we're seeing in the capital raise side of things, but certainly not on the acquisition side.
Great. Any other questions? I think we've got a good number of excellent questions that we've been able to deal with this afternoon. And if there are no other questions, we'll bring the webinar to a close. I want to thank Patrick for his excellent presentation, his expertise that he brings to this seminar, and also to all of you who joined us. Look forward to welcoming you to additional events over the course of the next year, 2017. Hope you all have a good holiday season, and look forward to connecting with you in 2017. Thanks, everybody.